Hello. Shinya, I think we are not able to turn on our cameras.
Oh, really? Okay.
Yeah. It says that the host has stopped it, so I'm not able to turn on my camera. I'm sure it's the same for the rest.
Yeah, that's happening for me as well.
All right. Let me check.
Hello, Shinya. Can you hear me?
Yes, I can hear. So I'm not 100% sure how to change. Oh, here we go. Okay, now you can try.
Hi, Max. How are you feeling?
Hello. I'm feeling a little bit better now, but I'm having my own self-quarantine stuff. So yeah, I cannot go out for these past few days because I just got COVID like I think yesterday or the day before yesterday. So yeah, life goes on. Okay, so
let's wait for maybe 1 more minute. And then I will probably let the Max to share his screen later on.
Is Mohan here? Maybe I'll text him. Can you hear me clearly?
Oh, yes. Yeah, I think
Okay.
your audio is good.
Okay, thank you.
Are we waiting for Muhan?
I texted him already.
Oh, is he?
I think he hasn't replied yet. But he's one of the last presenters. So if we need to go first, I think it's okay.
Okay. He's here, but not as a panelist.
We can upgrade him.
Yeah.
Oh yeah, okay, I think he's here.
All right, I guess everybody's ready. So I'll make up maybe the quick introduction first. All right, everyone, welcome to Z Club China Tech launch presentation. I'm very pleased to make this announcement and then to share this exciting initiative of Z Club. I'm not going to spoil today's presentations by talking too much, but then yeah, it's not rehearsal planning. It's it's a deal right now. But anyway, thank you for joining this. I'm very happy to share have this session today with a lot of people joining this, and this is one of the kind of a unique initiative of the Z Club. So as the most of you know, the Z Club is a student loan investment club. We have right now, including new members, I think we have over 70, 80 members. In Singapore, China, and then the Malaysia, Israel, Colombia, many other countries. So we are really truly international organizations. We manage the real money and then deploy this capital, and then so this time, probably a couple months ago, the Max and I had the very interesting discussion about the Chinese tech companies. We thought that the valuation of China tech companies is so cheap, but then not many people want to take risks, right? And then I was saying that maybe this is one of the one of the greatest opportunities or times that maybe we can to take the risk, and then we can enjoy this moment of taking risk, and then seeing the generating great returns. Of course, we don't know if we can actually make money or not, but then it's important for the club and the club members that they have to feel comfortable taking risks. And then what I have seen in many cases is the students or the young investors hesitate to take risk, right? And then if we don't make money after all, right, and then that's okay, right? And then we can learn from these experiences, right? This the real money experience is a lot more important than the reading books, right? And then so this is the greatest experience and moment that I'm very proud of. And then the Max definitely they help a lot on those the 4 other Z Club members to get on the speed and then conducting the deep research. So I was part of it. I haven't seen all the presentations, so I'm actually myself very excited to see what the Max, Pairing, Jinshan, Ginger, and then Muhan is going to present today to all of you. So I'll give you a microphone, Max, and then also screen. So please show us your China tech investment opportunities.
Hi, good evening, everyone. Tonight's presentation will be a brief one, and of course, we try to not complicate our pitch. We just share the simplest idea, maybe the 3 or the 4 most important points when we think about investing in a particular company, and also we insert our target price in the logo below, so you guys can see that what is the upside that we are projecting. But of course, we have models, and also we have we did our models also before that, and also we did our models before that, and also basically we just try to not complicate things and make it very simple for the next presentation. Okay, so just now Shinya gave a brief introduction about China Tech. So basically, the inception of China Tech started with a conversation with Shinya about the China Tech crackdown since the end of 2020, and also we saw that the share price kept plummeting, and without any rest, I can say. So so the share price actually went even lower after the tech crackdown since last year. So the price is actually kept on plummeting without any rebounds or anything. So it seems that investors globally are very bearish about China, about the political risk, and also about the policy risk. However, we think that actually there are a few very high quality names in China. So we actually did a research each week. So we actually finished 10 stocks actually. So not all stocks will be listed into the portfolio, but these 10 stocks are basically the first 10 that we have chosen, and we did deep research on it, and we include it into the portfolio. So later we will show you how is the portfolio percentage, the stock portfolio percentage in our fund. So basically, actually this picture inspired me a lot. So Shinya actually shared this picture with me since a while ago. So actually Shinya personally invested in 10 names since 2013. And basically most of these companies are consumer businesses in China. So during 2013, there was a bear market in China, and Shinya said that, hey, I think that there might be bargains in this market. So Shinya actually chose 10 stocks that he thinks that are high quality, and also that he thinks that might compound returns in the long run. So I think this really inspires me, because for me, as a manager of this portfolio and fund, what we really want is a long-term holdings of high quality stocks. And because actually I think that if we buy mediocre or businesses that are not that high quality, we're actually playing the what do you call it, mean reversal kind of strategy. So most of the value stocks in the market currently are probably value traps, or we as an investor are betting on mean reversal or value reversal. So after the value reversed, probably we need to find new companies and new stocks to buy. So I think that the best way to invest is to buy quality stocks at reasonable price and bet on the management team, because I think that management team is the most important in navigating through periods of crisis, like for example, recently the 2022 bear market in the US and also in China, basically. So I found out that Shinya chose 10 companies. So they are among the highest 10 companies that Shinya picked on the consumer sector. So I also hope that after this tech crash, our team will try to select 10 names that we think that might be a long-term bet going forward. And of course, the price now is really, really cheap. I mean, most Chinese tech stocks are really cheap. Of course, doesn't mean that we try to limit our position at 10 stocks because it's highly concentrated. But maybe if we found other names, we might dilute some higher percentage stocks in the portfolio towards the stocks that we think are interesting to invest going forward. So doesn't mean that the tech fund is investing into like software companies. So we might invest in like hardware companies also, technology hardware companies, like for example, Sunny Optical or for example, Tektronic. I mean, these kind of names that we're actually looking at currently. So there's no like software constraint or limits in this fund. So you can see from the graph here is that the original China portfolio 10 stocks, 10 years, and also I don't know another 10, what is that, but I forgot already, but basically 10 stocks, 10 years, and compounding in 10 years. So basically it's that, right? So it actually appreciated 227 times.
It's actually 10 years, 10 stock, 10 years, 10 times PE. And then we actually had another 10, because if you compound at 25% over 10 years, you can make 10 times returns.
Yeah.
So
correct.
real goal was
Thanks, Shin.
China 10, 10, 10, 10.
So thanks, Shinya, for the explanation. So basically, you see, there is actually really outperformer here, especially Quichon Multi. It actually went up so many times, even though, but basically Shinya paid very cheap for Multi. It's like less than 10 times, right? So that's why I think it really inspired me to help Shinya and also to create the fund and also to nurture the young talents in the group. So okay, so I just stopped introducing too much. So let's begin with our stock pitch. We actually researched for 10 weeks, so 10 stocks already. So it's better because we have something to show you guys, right? We actually did our job. We have something to show you guys before we actually launch it. So without further ado, let's invite Pauline to come and share her pitch, her stock pitch that she thinks might be a long-term investment company.
Yeah, hello. So I will start off with Meituan. So introducing Meituan, right? So Meituan is actually a Chinese shopping platform for locally found consumer products and retail services in China. So this includes dining, entertainment, delivery, travel, and so on and so forth. So for those who don't know what Meituan is, right? So imagine Meituan first starting out as a food delivery app. So imagine like Deliveroo and Food Panda in Singapore. So that's what Meituan is like. However, what is the issue with a food delivery platform itself, right? Is that food delivery business itself is very difficult to sustain because of the high cost in terms of operations. So actually the operating margin for Meituan right now for food delivery business is only 6.6%. And we also expect that it's going to get more difficult for Meituan because of Chinese authorities trying to order food delivery companies to improve the rights of their food delivery riders, as well as also trying to reduce the service fees that they charge restaurants. So we think that Meituan actually made a really right move by expanding its business beyond just food delivery platform. After attaining a really high market share of around 67.3%, making it the leading food delivery platform in China, it has such a strong customer base already, right? It actually expanded into a cash cow travel platform business. So think about like hotelsbooking.com, where you basically use Meituan to book for your hotels, for services such as entertainment, karaoke, and stuff like that. And because of its existing strong customer base with food delivery services, it's actually able to bring customers to actually go to such travel bookings websites, as well as entertainment services. And it was also able to provide a certain form of synergy. For instance, like if you go to this particular hotel, we can give you a discount on your food if you come back the next time round. And the thing about this travel platform business that we really, really like, and it's also what we're really betting on here for Meituan, is that he has a very high operating margin. So currently the operating margin for this segment for Meituan is actually at 43.3%. So that's actually really, very high. So imagine like if you spend like around so let's say if you actually spend $10 there, $4 actually go back to Meituan directly as profits. Yeah, and apart from that, for this segment, right, apart from the high operating margin, we also recognize that there's still a very high rate of growth. So why is that so, right? That's because we know a lot about e-commerce, about fashion, about food delivery, but when it comes to service e-commerce like traveling, entertainment, the penetration rate in China is only at 3%. So we believe that this is going to be the next area of growth. And also this whole online travel agency model is also likely to be one that is sustainable because it has proven to be quite growth compounding. Hotels actually operate with a pretty low variable cost, right? Because the amount of hotel rooms in the hotel is fixed. So they want to rent out as many hotel rooms as they can. So because of that, they're willing to pay Meituan in order for Meituan to actually try and rent out as many hotel rooms as they can. Yeah, so that's generally our key main thesis for Meituan, which is its cash cow travel platform business. And last but not least, as you see here, right, the potential to excel in the grocery business space. So there's another third segment that Meituan is working on, which is new initiatives. And out of the new initiatives, we're the most optimistic about groceries because the grocery delivery market in China is actually currently really the next pie that everybody is fighting for. It has very high competition with a lot of companies fighting for it. But if you look at all the various companies, right, we believe that Meituan has a high chance of winning because it has a very strong logistic infrastructure nationwide that's actually a lot more efficient and more suitable for grocery shopping compared to Alibaba and Pinduoduo. And that again goes back to its food delivery business, right? Because it has already been so familiar with all the logistics. So even though the food delivery business has low operating margin, it is actually the basis and the foundation for its other business segments. Yeah, and apart from that, we also see that the new initiatives that Meituan is investing in also includes like investing in drones for its food delivery business to reduce its cost of operations in the longer term. So generally, we think that Meituan is a pretty good business. We have high faith in the growth for the traveling agency and entertainment segment. And for its new initiatives also, we think that it's investing in the right place. So overall, in terms of financial performance, it's currently at a net loss, but it's actually already making a good profit for both food delivery as well as travel platform business. So it's only actually making loss in its new initiative segment. So as long as like it has like two stable revenue coming from the other two segments, we believe that Meituan actually is able to cut losses anytime that it wants to. And we also think that it's investing in the right place right now. So we have strong faith in its direction in the long run. So that's Meituan. And then next is Kingsoft. So as you can see here on the screen, it says gaming provider and Microsoft of China, right? So I'm not so sure how many of you here have heard of WPS before. Maybe you could just raise your hand or leave in the chat. Okay, I think nobody has heard of WPS before because everybody uses Microsoft Word, right? Yeah, so I'll just go straight to the point for Kingsoft. So Kingsoft has two revenue segments. So the first is gaming, but we don't really have that huge interest in the gaming segment because it's a pretty stable revenue. It's 49% of Kingsoft's revenue stream. And generally, it's getting a bit stagnant. So actually our main interest here for Kingsoft is really the whole part about WPS software. So if you haven't used WPS before, trust me, it's actually almost identical to Microsoft. So we all know that China is pretty good at replicating products from the rest of the world. And it has actually done so for WPS. So if you actually use the WPS software, right, it has very high product quality, almost similar to Microsoft. Some people even say that it's better than Microsoft in terms of its ability to share. So, we have Microsoft Teams to share, right? But sometimes like Microsoft Teams is a bit laggy. So some say that WPS is actually much better in that sense in terms of collaboration work. But okay, so we know that Microsoft already has a really strong market share and it's also really well used in China. So why do we actually bet now into WPS software? That's because China as a whole trend, we're actually seeing China trying to utilize its own products a bit more. So actually previously, we also saw China saying that they don't want to use some certain operating systems. They want to use Huawei. They don't want to use like outside systems, right? So actually, even for their own government agencies, they're actually shifting away now from the usage of Microsoft. And if you look at the alternative apart from Microsoft, what else can they use that is domestic, right? That's really WPS software. So WPS is the only one in China right now that is similar to Microsoft in terms of its functionality, professionalism, and it's actually domestic. All other competitors that we've looked at, such as Shimo, Feishu, Lapdogs, all of those actually are less professional and have less functionality. They actually give more of the Google Docs vibes. So because of that, we believe that WPS actually has a stronger advantage here and will likely be the next one to replace all the Microsoft softwares. And you imagine like the whole pie, right? All the government agencies all being replaced by WPS. And apart from that, WPS is also actually shifting towards a SaaS model, meaning that it's through a monthly subscription model. So that means we can likely see that there will be a recurring revenue stream coming up. So for this, we do think that we need to be careful, of course. So we also intend to continue to look at new updates about regulations for China to make sure that this trend continues on. Because as I mentioned, we're not that high conviction about the gaming portfolio. It's actually pretty stagnant already. The number of users has also kind of like become stagnant already. So we're really mainly convicted because of the WPS software. Yeah. Okay, now I'll pass my time on to Jing Xiang.
Hi everyone. Okay, I'll start with my research on JD.com. So JD.com is one of the leading e-commerce companies in China. It's now currently ranked second behind Alibaba with a market share of around 20%. However, the difference between JD and its competitors, including Alibaba and Pinduoduo, is the fact that it actually runs on a 1P buying model, which makes it very, very different from them as they run a 3P model. So what JD.com does is they source for their own goods and sell it on their they are not a marketplace business. They source their own goods and they sell it to their customers. So so this difference means that they have to be very, very good in their logistics network, which they have extensively invested in. So the thing I like about JD.com through the past few years was we know that since the coming of Pinduoduo, the e-commerce market has been in a state whereby a lot of people is just putting in a lot of subsidies to the buyers to gain market share. However, despite these strategies taken by Pinduoduo and Alibaba, JD.com was still able to maintain their market share and even had a steady growth through the past few years, which means that they were really very resilient with their strong moat from their logistics network. Moreover, because of China's rising middle class, we believe that in the future, more people will choose the premium services that are provided by their logistics networks, which offer next day delivery and such. And JD.com will be able to get more growth in the future. This logistics network mode cannot be replicated easily by their competitors because it really takes a very long time to set up these warehouses and delivery networks. So we believe that in the future, JD.com will continue to grow. Yeah. So the cutting of their loss-generating segments, including Jingxi, which was part of what Pauline previously mentioned, of the community buying grocery business, because this was a very loss-generating segment for JD because they had to put in a lot of subsidies to like snatch market share from the other competitors. So cutting of this segment would also improve JD.com's bottom line in the future. So in the long run, we believe that due to these tailwinds for JD.com, they will enforce their foothold in the e-commerce market and continue to grow in the next 10 years. So next, let me present on Beike. So Beike is a pioneering housing service platform in China. If you all have not heard of Beike, as a comparison in the Singaporean context would be something like Property Guru, but not really, because Property Gurus, individuals can go on to buy and sell houses. But in China, this is not really the case because houses are normally transacted through agents, and brands and agents are a very big thing in China. So, however, previously, the Asian market in China is very fragmented as one, and there were a lot of problems because of the fact that housing purchases are actually they are not really a repeat purchase for individual brands. So it is effectively a single game between buyer and sellers, which means that agents tend to take advantage of the customers, and agents get very bad reputation. So moreover, because of how they essentially earn through commission rates. So at the end, even if you go through the entire process of introducing the house to the customer and everything, as long as you do not complete the contract signing part, you will not get the commission fee. And there are a lot of undercutting between agents to minimize the commission fee, which leads to a very low margin for the entire market. So what Beike has done is they previously ran their own agent brand with their own local agents, but they decided that they had to reform the problems within the housing service market. So they came out with a platform allowing other Asian brands to effectively publish their listings on their website so that the network effect of the brands can be collaborated together to let more buyers match with sellers. And to prevent the problem of undercutting and low commission, what they did was came out with this pioneering agent cooperation network that splits the entire Asian process into various different parts. So for instance, the agent who introduces the customer to the house might get a cut of the total commission, and the guy that does the contract will get another cut. So through this cooperation network, agents are less inclined to undercut each other, and they're more inclined to collaborate instead, so that they can achieve more sales. So this network effect will basically benefit both Beike as well as other Asian brands that are not part of Beike. So everyone stands to benefit, and more people joins this network, and Beike will effectively gain a massive network effect solely because of the fact that housing is also such a big thing in the Chinese market. And from this whole process, Beike gets a commission cut from them. So that is one way they could gain market share, gain revenue. And currently, they only have a 13% market share of the whole market due to how fragmented it is. And we believe that they will continue to consolidate all these other brands on their platform to increase this network effect. So secondly, one more driver for Beike's growth in the future is the fact that they don't see just commission as their sole driver of growth in the future. They believe that with so many people on their platform, once you get like buy a house, you would think of things like housing renovation and stuff like that. So that's what Beike has been exploring, and they have purchased and they have bought over a housing renovation company called Shentu Rishen to do this. In fact, so this entire platform and its network effect will help it to catalyze its growth in the housing renovation industry. So yeah, we believe that Beike will have strong growth in the future. Yeah. So now I'll pass the time over to, I believe it's Jing Zhe.
Yeah. Hi everyone. So I will be sharing my two stocks that I have to research. Firstly is GDS. So they are the largest developer and operator of carrier-neutral data centers in China, and their data centers are actually located mainly in the country's economic hubs. So, for instance, your Beijing, Tianjin Hebei region, and the Greater Bay Area, where there's a high concentration of demand for these data centers. And they mainly earn their service revenue by providing co-location and managed services to their customers. So our investment thesis is this: they are a market-leading player with strong asset-based economic moat and sustainability performance as well. Because industry-wide, we can see that there's strong demand for carrier-neutral IDC players, given the strong growth of adjacent industries, your China software industry, for instance, your internet and cloud companies, to SMEs such as your application developers. And for GDS, we actually see that their total service capacity in tier 1 cities is more than two of their closest competitors, VNet and Chindata combined, and they still have a land bank reserved for future development that might actually double their total service capacity in time to come. And as a pure play wholesale IDC player, they're also really desired by your biggest players like hyperscalers like Alibaba and Tencent Cloud, who require a massive capacity given their scale, and they have actually locked in the biggest internet companies, including ByteDance, Baidu, and Huawei, amongst others, which will allow for platform network effects. And all this is actually reflected in their CAGR of 48% over the past 5 years. And we believe that their dominance will continue, especially in the face of tighter environmental restrictions. They're already curbing the growth and development of IDCs within the city centers. But actually for GDS, we see that their average power usage effectiveness of their data centers is 1.34, which is comfortably below the industry average of 1.5. And this will enable them to strengthen their already existing moat in the regions where there's a concentrated demand for third-party IDC players. And our 3-year target price is $56 USD, and 5-year is $97 USD per share, which is an upside of 251% for 5-year period. And this will derive from DCF model with exit multiple of 15.7 EV/EBITDA based on the mean trading multiple of comparable companies. Moving on to Mingyuan Cloud. Mingyuan Cloud is actually they provide enterprise-grade SaaS products and enterprise resource planning or ERP solutions for property developers and other industry participants across China's real estate value chain to help them achieve delicate and digitalized business operations. And they have 2 segments. So currently their SaaS segment consists of customer relationship management cloud, construction cloud, procurement, as well as space cloud. And as for their second segment, which is their ERP solutions, they have already initiated a transition to the subscription model early. And we believe that it is this full transition to a SaaS model that will actually help them realize their full earning potential in the future. Basically, the ERP solutions has a very high potential for growth as it helps the property developers to effectively integrate and manage their enterprise resources and optimize their core business processes with their products, including selling costs, procurement, planning, and expenses. And we see that real estate digitalization is still in their primary period, and its size is relatively small compared to digitalization in China's retail, finance, and other industries, right? But I think Million Cloud is a clear market leader in this aspect because they've actually locked in 97 of the top 100 property developers in China. And there's actually a high customer account retention rate of over 85%. And we see that on top of locking in the biggest property developers over the years, which has stayed consistent for the past 2 to 3 years, they've also increased their property developer customers by 44% in the most recent year. And yeah, lastly, in terms of their operational and R&D excellence, this is actually reflected in their high gross margins of about 80%, which has also remained consistent in the past 5 years, as opposed to larger ERP solution players, right, like Kingdee, which is now actually trending downwards to about 65%. And yeah, but of course, it is situated within a very challenging industry, real estate industry in China now. But we believe that it's a SaaS business, and even in a sectoral in a time span where they're facing sectoral headwinds, they will still be able to consolidate their market share further, given that they've already locked in the biggest developers. And actually, their resilience can also be shown in their revenue growth in the past year. When we see that actually across China's real estate sector, revenue probably has plummeted about 50%, but they actually have maintained a strong revenue growth of 28% in 2021. And as for our target price, our 3-year target price is $1.54 USD, and 5-year is $2.04 USD, which represents an upside of 122% over the 5-year period. And this will derive from DCF with exit multiple of 16.9 EV/EBITDA, which is the median trading multiple for B2B SaaS services. Yeah. I think I'll hand over the time to Mohan.
Okay, hi. Thanks for sharing, Jinze, and thanks, Max and Xingye, for the introduction. So I'll be covering 2 companies, Tencent and Bilibili, which arguably are the 2 very much household names in China. But I'll just give a very brief introduction about each company first. So Tencent is obviously a technology juggernaut in China. They have mainly 4 business segments, so namely value-added service, fintech, and business services, online advertising, and others, which mostly consists of their investment. We believe Tencent is at a very attractive price right now, and it has strong future growth potential for 3 reasons. One is their strong future growth potential despite its already large size. Second being their great management team, which can navigate the quickly changing business landscape in China and capture the opportunities. And third is their high likelihood to generate strong streams of cash flow by capitalizing on their existing business and services. So just to cover the first point, why do we believe they have a strong future growth potential despite its already large size? That's basically because even despite the tech crackdown and the tightening regulation on especially the gaming segment, we actually see that their gaming business is still growing pretty fast for the past 2 years, and it is expected to grow about 14% from 2021 to 2026. And also we see that for their signature payment app, which is the WeChat Pay, it is expected to continue to grow. The corporate strategy for WeChat Pay for the past few years has been offering the service at a very low fee or at no fee at all in order to capture the market share. But moving forward, on the one hand, we're basically going to see that the mobile payment market continue to grow. It is expected to grow up until $18 trillion by 2025, according to some research. And on the other hand, once WeChat Pay is able to attain a competitive or a dominant position in China, then there will be more able and more capable of monetizing on their payment service. Moving on to the second point, which is about their great management team. So we basically see the core team consisting of Pony Ma, Martin Lau, and Alan Zhang, who is the head of the WeChat business. They have a very proven track record of successfully managing their business and growing their business. And also they have been in the industry for a very long time. And they are also at a very relatively young age. So on average, they have spent 17 years in their respective positions, and they're all in their late 40s and early 50s. So we have great confidence in them navigating Tencent in the changing business landscapes in China. And we believe, in the future, that's going to be vital for the company's continued success. The third point is the high likelihood to generate strong streams of cash flow in the future. So basically, the belief is that Tencent is actually not very aggressive in terms of monetizing on their business. For example, digital marketing. They have huge traffic on their WeChat Moment, advertising, as well as the WeChat articles. But they're actually not putting that much advertisement to monetize all of those services, because Tencent was mainly focusing on gaming, and it is one theory suggests that basically they want to use that potential as a reserve in case other parts of their business kind of slows down. So we think there's a huge potential for Tencent to continue to grow their free cash flow margin if they really wanted to. And that's another reason for confidence. So that is Tencent. Basically, the current stock price is trading at around 40 USD, which is extremely cheap, according to our belief. And our 3-year target price is $62, and the 5-year target price being $86. So moving on, I'll be covering Bilibili, which is another household name in China. In short, Bilibili is dubbed the next YouTube of China, in terms of Bilibili being the first kind of widely adopted platform in China to truly have user-generated content as their main sources of content, as compared to previous kind of video streaming platforms such as Mango TV, iQIYI, etc., whose content mainly comes from the company itself. But Bilibili has the promise of offering much more than just being a YouTube. In fact, they're basically building an entertainment, all-in-one app, and with kind of the goal of eventually attaining a super app status. We think they have two competitive advantages. One is being their continued versatile user acquisition strategies, and second, being that as a result of their continued user acquisition strategies, they have a very diversified channels to monetize their users. So the first point is Bilibili has used to be mainly focusing on the first tier cities, and originally its core user group is the ACG, basically stands for anime, comics, and games. But Bilibili has been working very hard to rebrand itself, to shift away from just the ACG users, especially by changing its slogan to quote, videos that you are interested in, all at Bilibili. And if we actually look at comparisons from other major video streaming apps such as iQIYI. So iQIYI has about 600 million active users, and Tencent have about 500 million users. As of 2020, Bilibili only have about close to 100 million active users. So there's still a huge room for Bilibili to continue growing its user base. And in fact, when we look at the content strategy of Bilibili, it used to be having a lot of ACG content. But Bilibili is basically doing two things. One is to diversify its user-generated content. So it's offering a lot of education content, a lot of gaming content, streaming, basically to just stand true to its slogan, like videos you're interested in, all at Bilibili. On the other hand, Bilibili is also adopting the Netflix model of producing a lot of its own content in terms of partnerships with content producers, or coming up with its own dramas and shows. So we think there's still a very huge room for Bilibili to continue to grow and truly be the go-to platform for video content in China. Another point is that in order to monetize on its users, there are still multiple channels for Bilibili to do so. It's very under monetized right now. One of the most important feature differentiating and distinguishing Bilibili from other platforms, which arguably led to its rapid growth, is Bilibili has no ad. So basically, if you go to Youku or iQIYI, and if you're not a paying customer, or even if you are a paying customer, you will be forced to watch 30 seconds, or even up to 1 minute of advertisement before the video starts streaming, which is extremely frustrating for users. But Bilibili initially made a promise of putting no ad to the video streaming per se. And that's what allow you Bilibili to have a very superior user experience. We believe that even absent the putting the ad on the video or streaming per se, there are still a lot of ways for Bilibili to monetize its users. For example, the games that Bilibili launched, Ginseng Impact, was actually a huge hit, and they have a very healthy pipeline of other games being developed. There's a chance of increasing its overall impression by putting more advertisement, by diversifying its ad format. So by placing advertisements through different mobile platforms and different placement format, and also they can have a lot of partnerships as well. So overall, but at the same time, we also believe Bilibili is challenged in many ways. In a sense, it doesn't have as strong of a competitive position as Tencent, mainly because Bilibili is challenged by platforms such as TikTok and Kuaishou. And arguably that might be the future format of video streaming platform in China. And research shows basically on average, users spend about 80 minutes per day on consuming video content, and that's a zero-sum game. It's either on Bilibili or on other platforms. So overall, we believe that Tencent is a very clear buy, has a very clear competitive advantage, and we have very high conviction. For Bilibili, we think it is a promising buy, but also it faces some competition. So that is our research and assessment on these companies. I'll pass the time now to Max. Thank you.
Hello, everyone. So two stocks I'm pitching. One is Alibaba and one is NetEase. So Alibaba is a strong cash cow marketplace with maturing growth in e-commerce, cloud computing, and also strategic investments. So they're actually maturing now, and on their online retailing sales, and also in rural areas and towards consumer-driven economy, even after the technology crackdown in China. So Ali Cloud market share is approximately 40 to 50% in China. So recently, I think the yesterday report shows that they still have strong growth in latest quarter, but of course, slowing down due to technology crackdown. So the usage of the Ali Cloud is getting lower due to the crackdown. So it still grew 10% because due to the economic transition to cloud computing, and also the ad monetization. There's still ad monetization improvement for Alibaba, and also currently the take rate is around 4% versus Amazon's 12%. And also Alibaba currently there was a 25 billion share repurchase program by the management, still indicating confidence in the company. And also the company is an integrated ecosystem platform. And also Alipay's rivalry with Meituan Dianping currently is still very strong. So Meituan is winning in terms of the food delivery business, but I think that Alibaba's share price is too cheap to ignore. Of course, we using a sum of total parts valuation method to value Alibaba. So currently the market cap of Alibaba is around 260 billion or $97 per share. And in the 3-year target price is around 530 billion. Sum of total parts is 200 per share, and also 5 years target price is 700 billion at around 260 US dollars per share. So the share price currently is very beaten down by investors, because everyone is thinking that Alibaba is not going to grow, revenue growth actually fell. But I think overall competition is also increasing due to Pinduoduo entering the market, and also Kuaishou and also TikTok. They're actually having a e-commerce channel in their apps. So competition is basically getting tougher and also getting more difficult for the company. However, I think that the business is still very undervalued in terms of pricing. So at around $97, I believe that the upside is still huge for the company due to the price. And also NetEase is a very special company. It is a global game provider with ingenuity and innovation. And they actually successfully get penetrated into the Western markets with a very strong free cash flow. So NetEase excelled itself in comprehensive game portfolio of top MMORPG games. They basically create their own games, not like buying studios and etc. They create their own games in-house. And they are basically a very innovative company from what I see. And also they pay dividends very well. Since inception, they kept on paying dividends, and investors are very happy with the company since the IPO. And also it is backed by differentiated designs and effective localizations. So that's why it causes Netflix flagship games to gain traction overseas, such as the Japan and Korea market. But recently it gained traction in the US and the Europe market with its Harry Potter games. And of course, the company is also unlocking TAM with its music segment. NetEase Music is a much better has much better user interface, and also has much better song recommendation engine in comparison to like Tencent Music. And recently, after the tech crackdown, actually it benefits NetEase more, because a lot of exclusive titles in music is actually not constrained anymore by just Tencent in the past. So now NetEase also can include previous exclusive musics like Jay Chou and from like top stars in China. So actually it benefits Tencent Music. NetEase Music in the long term. And also the education and other innovative businesses is the second growth engine for the company. And it is a very defensive name among market uncertainties. NetEase has generated stable operating cash flow and remain net cash position in the past few years. And also actually it's due to it's due to its strong ability to sustain long life cycles for its top games actually. So that's the reason why NetEase is a company that we think is a ballast for our portfolio. So we will invest in the company going forward. And they're actually creating games. Their pipeline is still very strong. So we think that it is a very good defensive name in our portfolio. So the market cap currently is around $60 billion. It's around 89 per share. So the 3-year target price is around $123. And of course, the 5-year target price is around $150. So that's it for NetEase. So the China Tech Fund portfolio positioning. So currently, after our discussions, we actually weight our position in the portfolio. So of course, currently less than 3% will not be included in the portfolio after consideration, but it might be in after future consideration because we still have names in the pipeline. So GDS will be inside. JD, Tencent, Meituan, Alibaba, NetEase, Mingyuan, and Kingsoft will be the first batch to enter our portfolio. But Bilibili and Baker, we are still monitoring, and also we are still observing the company currently. And yeah, so that's the reason why we actually didn't weight both of them into the portfolio. But the 8 names here, we should say these are the highest conviction names, and basically these are names that we think how to say Chinese investors darling in the past, and now is actually Chinese investors garbage. So we believe that it is a really good time to relook into the names of these several companies and to include it into our portfolio going forward. But of course, not all of our names will be like software names or like some infrastructure names, but maybe in the future we might add like hard tech names. But this fund is basically focusing towards technology companies. So we try to have our own constraint in technology names due to the agenda of the fund. So that's it. I think we actually done a very good job. Our team, I believe they try their best. They keep on learning, and I hope that they will get better going forward in the long run. And of course, thanks for joining our session tonight. And if there's any question, we will be very willing to answer. Yeah, thank you very much for participating. The next session.
Okay, Max, thank you. This is great. Max, Hyun, Ginger, Jinxiang, and Muhang. Great job. So I just want to explain to everyone, joining this, the session once again. Just a disclaimer: we're not making any recommendations on, the buying stocks. Right. So this is purely, explanation and then information sharing of what we are doing at the Z Club. And then again, the whole purpose of the Z Club is education. Right. And then the parent of the Z Club is the non-profit organizations, and then we are generating returns to support the scholarship. Right. And then so that's our missions. Right. And then at the same time, our members are learning how to become investors. We're helping everyone to become the great investors and starting their investors journey. Right. So this is a part of education process. And then the Max did an extremely good job, they're helping, the younger investors. Right? And I think most of them have, very limited number of, the investment experiences. So what I'm asking you, audience, is please submit your questions, and then especially tough questions, because that will help them to become better investors. And then given the time limitations, our session is pretty short. Right, but then they actually did the full length of the investment analysis, which we will share through the mailing system, LinkedIn, and then WeChat. So please pay attention to our communications so that you can see much deeper investment analysis they have conducted. Right. Okay. So let me ask the question one by one. From the audience. And some of the question is pretty tough to answer. So hope you can answer and then convince the the audience. And then also the audience, please raise your hands. There's a the function to do this. And then if you can actually ask questions to our members directly. Okay, and then that's also we want to see some interactions as well. Okay, so the first questions. This is for pairing. It's coming from Jeffrey. He's asking for Meituan. The 3 years and then 5-year price target is not very attractive. Right. Okay. Well, I think sometimes I see the similar issues that, hey, you're so bullish, but then the target price is so attractive. right? And then I know Meituan had the the great recovery from the March low, but then I think that Jeffrey's questions and a little bit too conservative to make everybody excited, right? Telling how do you explain this?
Yeah, I think that's a tough question. I think generally when we're doing our modeling, we're a bit more conservative. So I think just now I shared the whole story about Meituan, right? But we also took into consideration that the food delivery business is getting more hit from the Chinese government and all that kind of concerns, as well as the fact that it's still not really making a profit right now. It's still overall making a loss. So I think that's why our target price is still a bit conservative. But we also took into consideration that for this fund, we're actually aiming to hold for 10 years, right? Which is why it's a 10-10-10 China Tech Fund. So even though the 5-year target price it seems a bit low for now, we believe that by the end of the 10 years, that should give enough runway for its new initiatives and technology to actually realize. And hopefully by the end of the 10 years, we will see like a better target price. Yeah, but we did not do the modeling for the 10 years yet for now because we feel that there's a bit too far ahead for us to model. So we'll probably like have a checkpoint nearer the date where we'll value the company again. Yeah, but I definitely take into consideration about that. So I think we'll definitely look into it again and see whether or not there might be another better, higher conviction stock that we can take to replace Meituan. But as of now, there isn't really any other business like Meituan, right? Because it has a really strong foundation with the food delivery business, the leading one in China. And with its expansion into the traveling platform, we believe that would definitely give it like a really good placing in the China tech market when it comes to like becoming a super app. Yeah.
All right, Pearling, thank you. Jeffrey, is it good explanations? Are you convinced? If not, please ask another questions. Okay, I will let the Javier ask questions directly because he is kind of brave enough to ask questions directly. That this is good. All right, I will set your microphone on. Hi, Javier.
Hello, can you hear me?
Yes.
Yeah, hi. So thanks for the presentation. Really enjoyed it. So I just wanted to ask like a quick question on JD, right? So I went to look through their financials, like just screening through, and their gross margins are pretty low, right, at 7%, and this has stabilized across the past few years already. So personally, I think it's because of their business model, right, where they just buy directly from the manufacturers and then they resell to their customers, which is essentially like almost a drop shipping kind of model, right? But that would mean that I think the operating leverage is quite low. So do you think that they have any like sort of plans to increase their operating leverage in the future? And if they don't, like, do you think that could be an issue? Yeah, in terms of like being able to scale. Yeah.
Sorry, I'm actually not so sure about what do you mean by operating leverage. Do you mind if you like define it a bit more? Because yeah.
Like operating leverage is like what percentage of their total costs are fixed. So like since their gross margins are very low, means that on every transaction there's like a high proportion of cost of goods sold, right? Which means there's a lot of variable costs.
Yeah.
Right.
Okay.
Yeah. So like even if they were to sell more items, they'll be incurring a lot of this cost. And like with the lack of that fixed cost structure, there's just this lack of operating leverage. It means when they scale larger and larger, and if they sell more stuff, it's hard for them to become more profitable.
Okay.
So do you think this could be an issue?
I think that apart from like JD's e-commerce site, they're actually like trying to grow just its logistics network as a separate service in itself as well. Yeah, so because I'm currently in China now, I've been seeing like them offering JD's logistics service itself. Like so they are trying to explore like perhaps a different kind of model. So another way that I understand that they have been trying to, come out with another driver was through JD Health. But then again, that would also fall to what you have mentioned, like they're also just a reseller. So yeah, but I think maybe to increase their margin is mainly on the like using the logistics as a service itself, but then they are trying to push up. Yeah.
Okay. Thanks.
All right. So if you have any other questions, please raise your hand. I will prioritize, the real voice questions. Right. There are a couple of very tough questions, so I'm not sure if you can actually answer those questions properly. But then a lot of people have questions on Bilibili. So this is a question to Muhang. Okay, so the first question is, like other streaming platforms, Bilibili earn the money through commercials. So they, like other streaming, so the platforms, they make the money through commercials. How about Bilibili? You answered these questions, but then can you clarify one more time? Like, how do they make money, the Bilibili?
Sure. So thanks for the question. So I'll just clarify, like, according to our research, they have mainly like 4 different revenue streams in descending kind of order of contribution. The greatest channel is actually in-game purchase, which contributes 43% as of 2021 of their revenue. Second being advertising and e-commerce, that's 23%. The next 2 being membership and live streaming tips and revenue. So that's about 12%. So that's how that's their revenue sources. And that's also the reason why I made an argument that there was actually a huge room for them to increase their revenue from advertising, especially because I'm not really sure, I can't really remember the figure correctly from YouTube, but the bulk of YouTube's revenue came from the bulk of the revenue of YouTube came from their advertising. But for Bilibili, that's not the case. Like their advertising only contributes about 23%, and then their membership is only about 13%. So we think there is still a very huge room for growth in those 2 channels.
All right, Muhan, thank you. Okay, David Zhang, he raised his hand. So I will ask him to ask questions directly. Hi, David. Thank you for joining the call.
Hi. Thanks for the presentation. I got 2 questions. First is among the 10, which ones are more likely to fail in next 5 to 10 years? And the second question is, among all these candidates, which one has the best profitable growth with product penetration and share gaining? Thanks.
All right, who wants to answer this? Maybe we should probably ask these questions one by one. Okay, maybe Max at the end. So do you want to start? Ginger, can you start from you?
Yeah, sure. You can. Yeah, just share my opinion. I think, okay, I'll just follow our portfolio positioning. I think overall, in terms of our highest conviction pick, it's GDS Holdings. In terms of market share and profitability in the next 10 years. Why market share? Because I've covered that in our investment thesis, which is its mode stands from its asset base, right? And it's really both the existing total capacity in tier 1 cities, which witness a disproportionate demand for IDC data center services, and their sustainability performance, which means that their competitors cannot easily dethrone their dominance in these regions, especially in the face of tighter environmental restrictions, right? They're already curbing the growth of data center service providers within these key cities. And on top of that, GDS has actually locked in the biggest internet giants, companies, as well as strategic partners with the Chinese banks, and even in the Southeast Asia region. We see there's some growing expansion with their strategic partnership with GIC, for instance. Yeah, so their mode is set-based, and it really rides on the tailwind of growth of adjacent industries, so internet and cloud service providers. And yeah, I think that's why we feel that they'll be the most likely to rapidly expand their market share. And in terms of their profitability, what is hindering their profitability currently is the massive expenditure on capex in the past 5 years. But in just last quarter's guidance, management has actually signaled that it's gonna slow down their capex expenditure. So for this year, they expect it to be a 12% decline from the past year, and we should see that what drives their revenue growth over the next 10 years should be the incremental increases in the utilization of their data center space instead of further aggressive expansions, right? So we will see incremental increase in the utilization rate where they are tapping on greater optimized usage of their existing capacity rather than just building new data centers. And I think as for the stock that is highest, likelihood of so-called failure, right, in the next 5 to 10 years. Personally, okay, even though it's not our least conviction, it's not Alibaba, but for me, I would say it's barring the 1% place, I would say it's Ming and Cloud amongst the top 8. Because as I also mentioned, it really is situated in the real estate sector, and they rely on their real estate clients. And given the headwinds that are projected to last at least the short to medium term, at least within the next 1 to 3 years, we could see that this will impact their revenue growth, and we have to closely monitor their customer retention as they transition to a SaaS model as well. Because we can also see that in the past year, they have actually spent a massive amount on sales and admin expenses to grow their user base. But whether they can retain these customers amidst the broader sectoral headwinds is yet to be seen. Yeah.
All right, great. Let's make your answers a little bit shorter because I want to ask the questions to a few more people. So, Pei-Ling, what do you think? Do you have any views?
Yeah, I think it's the same for GDS because I think we're a China tech fund, right? And data centers are so important to the growth of tech in China. So I think definitely GDS has a strong moat and he has clients that are likely to stick with it because they're all B2B clients. They have already signed contracts with them. Yeah, so GDS is the same for me. I think the lowest conviction stock for me would be Bilibili. So just add on to all the challenges that Mohan already shared. I feel that one thing that we discussed about Bilibili is that the content that is generated, it lacks diversity and it's not able to be as engaging because unlike YouTube where you have like people across the world, right, to share different kinds of content, different forms of stories, but Bilibili is very much concentrated only within China. So I think that was one point that we discussed as well, that we feel that it might be quite difficult to continue to capture engagement. And also because they are long form videos, right, compared to like short form videos like TikTok, it requires even more attention span. Yeah, maybe Jing Sang, you want to go next?
Yeah, sure. Same as the two of them, my highest conviction will be in GDS, also because of tailwind and how important data centers are for the future. So the one that I feel will be the worst will also be Bilibili, solely because I feel that they will have trouble generating their user base, like generating revenue from their user base, which they're actually already facing now. So yeah.
All right. So instead of asking, the Mohan and Max, what do you think? Do you disagree with this? Because everybody has the same opinions, which I don't like. There should be different opinions.
So I'll share like a slightly different opinion. So for the most risky investment, I agree, is Bilibili for the aforementioned reasons. I will not repeat. But personally, for me, the highest conviction is Tencent, for the simple reason that there are only 2 tech conglomerates in China, one being Alibaba and another being Tencent. But if we actually do a comparison between their core businesses, WeChat has an absolutely unchallenged competitive position in China. but the same argument couldn't be made for Taobao or AliExpress because you have challengers such as Pinduoduo or JD, which are challenging Alibaba from both end, the high end the high end user and the low end tier 2, tier 3 city user base. Versus WeChat, it is truly a household app. And second point being their management team. So obviously there's quite a lot of political problems with the Alibaba's management team, and it is not clear that Zhang Yong, which is the current chairman, was able to lead Alibaba in capturing key market share, especially being their cloud computing segment, versus Tencent, whose management team, which in my personal opinion, have superior management skills, but also they have very good judgment on the political situation, in a sense that Ponima, like 3 or 4 years ago, already mentioned that Tencent's new mission will be 科技向善, which is technology for good. So in a sense, he was able to kind of strategically assess the political situation in which China was heading to, and to preemptively kind of hedge against the regulatory risks. And that's especially important for doing business in China. So I think for these two reasons, Tencent will be my highest conviction stock.
So let me ask Mohan the follow-up questions. You have a little bit different backgrounds from other members, which is you actually started business, right? And then the somewhat related to the Tencent Alibaba ecosystem, right? So so you are the students, but already have an entrepreneurial experience, which is very unique, right? Can you share maybe your experiences with maybe Tencent, Alibaba, or those the internet giants, and then if you have any views that help you to have the different views?
Sure. So after high school, I had a startup in Singapore. Basically, it's a advertising and digital marketing company that helps mainland Chinese companies to expand their market share in Southeast Asia. We mainly provide business advisory and offline and online marketing support to those Chinese companies seeking to hire, right, to expand into Southeast Asia. And a bit of disclaimer, I think there's a little bit of conflict of interest in a sense that we were like a designated advertising agent for WeChat ads. So we have a contract with them, but we also have a partnership with Alipay. So we get a little bit of traffic from Alipay as well. So I would say based on my personal experience, I think definitely the main sources of traffic for Chinese tourists going overseas, in the pre-COVID days, obviously, are still WeChat and Meituan. So a lot of them continue to use Meituan when they're in, let's say, Tokyo or Kuala Lumpur or Singapore. There are like local agents who kind of curate all those contents for them, we being one of them. And also WeChat moment ads, like the advertisement you see on WeChat, actually can target overseas customers as well. But recently they shut it down due to privacy concerns. So that's also a reason why I said Tencent is actually very attuned to the regulatory kind of directions China is going, because they have been back and forth in allowing overseas targeting and not allowing overseas targeting for quite a few times, and we have to kind of be in a constant negotiation and discussion with them to get updated. And just one last point I want to mention is I think Tencent is much better at strategic investment than Alibaba, because Alibaba invested in so Tencent invested in Shopee, which is its parent company being seized. And just based on my experience and based on using Shopee app, I think that's a much better, much superior user experience than what's the other app's name? I forgot.
Lazada.
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 Yeah. Even though Lazada came in much earlier and they initially had a much larger market share than Shopee. So yeah, overall, I think that confirms my thesis that Tencent has a superior judgment and also have superior management capabilities on their own company, but also on their subsidiaries and the companies that they invest in.
Sounds good, Muhan. Thank you. David, did they answer to your questions?
Yeah, I like the answers. I think let me share a little bit tips. How do you answer and think about those questions? Because we have our internal debates all the time. Let's picture them like a rolling snowball falling from a mountain, and we want to see a bigger snowball and stronger and bigger, and then that's the compound we want to buy. And so for Tencent, I think they do have a strong profit pool. They used to grow by two folds. One is their core business with great products. Another is through investment. The challenge now is under current regulatory environment, the compounding machine by strategic investment are almost damaged by current anti-monopoly policy. So that's a concern we need to think about. Global expansion, I think, is tougher because of the China-US competition, which will be the case for next 5 to 10 years. So that's a question we need to wait. And for GDS, I think I like the growth. The question is when there is more consolidated clients, how can they still keep a strong profitability? And so a question to the team is, do you know their internal IR requirement when they try to bid for the order? And I know they also have a more balanced, less concentrated customer base, but can I still keep doing that in the coming years? I think all those questions matter. So I hope it's a ongoing debate, and I really enjoy the conversation with you guys. Thanks.
Great, thank you, David. I know some of the members have to go, so I'm going to wrap up today's sessions. Just I want to answer the question from Ming that why internet space. This is maybe I can answer to this question very quickly because the China internet was obviously oversold, and then I told Max when they started this China 10-10-10. The reason was I'm not a sophisticated investor. I'm not a stock picker, but then I can see value in those 10 companies, right? And then I said, all right, I don't have to make it so complicated. Just make a simple assumption that the Chinese high quality companies are so cheap, and I can see the same situation in Chinese internet companies today. Right, so that was where the conversation started. Right, and of course, the Z Club members are still students, right? And then they are learning how to be great investors, right? And then they're still their 20s or maybe sometimes their teens, right? They still have 80 more years to go, right? So this is a real opportunity to compound on the next 80 years, right? So they're just at the starting point. So I know there's some of the the professional investors, including the David, who has a lot of experiences, to join today's session and then gave us amazing advice, right? And then the sharing. We love this. And then thank you very much for joining today. And then hopefully we can continue this conversation with everyone who joined the the discussions, in addition to the Z Club members. Right. I know Max, is the showing up today's session, even though he is suffering from COVID. So we should probably, instead of letting him talk, I'll probably wrap up. So, well, thank you, everyone. We'll keep updating our the China Tech portfolio. We are going to deploy the real money into these portfolios. So you will see, right? And then if you make money, great. If you lose money, we'll learn from this mistake, right? So we're gonna win anyway. So and then if you can win your supports and then the help over the time, that's even better. All right. So thank you very much for the joining today on the Friday night, and then we'll see you again.
Thanks. All right.
Bye bye,
Thank you very
everyone.
much.